Financial markets overall had a mixed start to 2024 after the strong finish to last year. On the one hand, certain pockets of growth assets were lifted by data which supported the soft landing economic view. However, some central banks' rhetoric on the timing of rate cuts also proved a headwind for defensive assets. Following last year's success, it was Japanese equity markets that led returns once again this month. Commodities also performed well on the back of hostilities in the Middle East and around the Suez Canal. So starting with the economic overview, a number of data releases over the month confirmed the resilience of the US economy, which is still the key driver for the global economy. This included a fourth quarter 2023 GDP figure that was ahead of expectations at 3.3%, and also a strong jobs report for December, which showed 216,000 extra jobs were added to the economy, alongside firmer wage growth and unemployment remaining at a steady 3.7%. This news initially lifted US markets, but the US Federal Reserve meeting at the end of January suggested a near-term cut in interest rates is now unlikely and impacted growth asset sentiment as the month closed. So turning to growth assets, in the US, major indices were driven to record highs in early January as confidence around a soft landing scenario continued the rally in the Magnificent Seven technology stocks. However, concerns over their valuations remain. In the UK, growth assets paused on the back of mixed economic data and continued concerns over a slowdown in the domestic economy. In Europe, markets made positive headway as the European Central Bank kept rates on hold at its January meeting. China impacted the wider emerging markets picture as the domestic economy continued to struggle despite fourth quarter 2023 GDP numbers, which showed a 5.2% year-on-year growth, which was in line with expectations. However, disappointing news on economic stimulus, housing and retail sales hit market returns. Turning to factor performance, it was the momentum factor that was the best performer over January, with small cap the relative detractor. ESG portfolios found progress more difficult as the growth factor made only modest headway this month. Turning to defensive assets, major government debt gave back some of last year's returns as financial markets scaled back both the speed and number of rate reductions in 2024. Global government bonds were down 1.8% over the month, but it was UK gilts that really languished as wage growth and inflation concerns made the prospect of near-term rate cuts from the Bank of England look less likely. So in summary, we see a continued defensive positioning in portfolios in the near term, and that reflects what is seen as an optimistic scenario priced into markets versus concerns over the elevated risk of recession and further disinflation. Given this uncertain start to 2024, therefore, maintaining a balanced portfolio of assets remains key to navigate the first quarter of this year.